things were boring in the gold and silver markets. Well, not anymore. The gold top, if you can see the candle, hits here at about 5,600. That is the top in gold from January 29th. And we've been in a very, very tight triangle ever since. Imagine what happens to gold and silver when there is one final emergency cut to zero in a banking crisis. The spread between the 3-month and the 10-year Treasury yield. This is now reaching the same level that it's reached during the past 4 recessions. This is the 5th largest jump ever in 30-year yields. The Fed is losing control of consumer prices, and they're supposed to hike when consumer prices start to get out of control, which they are now, but they aren't, which means that they're not going to control inflation. And 6 to 8 week bottoming pattern so far. So this is really the reason why I'm pretty sure this is a bottoming pattern. Nothing is 100%, but here's the evidence that 9 weeks, this was one of the longest that we've had in 2018. 1, 2, 3, 4, 5, 6, 7, 8, 9 before we had the next move up in gold. And then I just said that things were boring in the gold and silver markets. Well, not anymore, not after what happened on July 29th, because on July 29th, we had one of the rarest moves in the gold market ever, and that is what I call a gold flag, and that is when stocks, bonds, and the dollar are all down, but gold and silver are up. That's what happened on July 29th with the 5th biggest move ever, biggest daily move ever in the 30-year bond yield, the 5th biggest one ever. People ask me, how do you know there's only going to be one more financial crisis before the end game? Well, the answer is because of what happened on July 29th. And that is the Fed did nothing, and long-term yields spiked by the 5th highest daily move ever, and gold still went up and stocks still went down. These are the types of moves we will see in the end game, except in the end game they will be much more extreme. But if gold is moving like this and stocks are moving down when the Fed does nothing, imagine what happens to gold and silver when there is one final emergency cut to zero in a banking crisis. Gold will move thousands of dollars a day. Silver will move even faster by percentage. And the dollar will die within days to weeks after that final cut to zero in an emergency. But besides that introduction, today I wanted to go into the bottoming pattern in gold that continues. Is it a bear market pattern or is it a bottoming pattern? And we'll go through the history going back to the 2015 bottom and even before during the bear market from 2011 to 2015 to see if this pattern that we've been seeing in gold since mid to late June is a bottoming pattern or is it a continuation of a bear market pattern? And the answer will be very clear once you see these very obvious charts.
Stocks, bonds, and the dollar rarely weaken together, yet that unusual combination just flashed again. Rafi Farber notes this followed one of the largest one-day jumps in long-term Treasury yields. But the deeper issue is confidence, not volatility. Markets may be signaling that investors increasingly distrust policy responses before officials admit any problem. For savers, ignoring that shift could prove costlier than enduring temporary price swings. Next, Rafi Farber reveals why recession signals and bond markets are telling dramatically different stories.
First slide we have here is the spread between the 3-month and the 10-year Treasury yield. And this is now reaching the same level that it's reached during the past 4 recessions. You could say 3 recessions. In the last recession in 2020, we weren't even at this level. We already passed the level in 2020. But you can see here that these gray areas indicate recessions, whether triggered by a financial crisis or a mini financial crisis, as was happening in those years. You can see that we get around to this spread between the 10-year and the 3-month yield. And with the spike in long-term Treasury yields on July 29th, we finally reached this little area. And it triggered a recession in 2008. It triggered a recession in 2001. It triggered a recession in 1990, and also in the 80s here, which you can't see on the graph because it's a max chart here. But it also happened in the 80s every time. Well, you can see here that sometimes there's a little delay, as there was in the late 90s and around the year 2000. We did hit this level without a recession, but then we went to a negative yield curve over here, and then once we hit it again, we hit a recession. So chances are this is going to trigger a recession this time. It's not 100%. Nothing ever is, but we're in that territory where these financial crises tend to happen because the spreads on the bond yields trigger changes in the way that credit is produced, and it will again this time. But let's go to the next slide here.
Markets often break long before headlines acknowledge the underlying stress building beneath them. According to Rafi Farber, the 3-month versus 10-year Treasury spread has repeatedly reached similar territory before previous recessions unfolded. Historical patterns never guarantee identical outcomes, but institutional credit conditions deserve far more attention than daily market noise. Investors focused only on stock indexes may overlook where systemic pressure first appears. Next, Rafi Farber exposes why today's bond market timing contradicts the Federal Reserve's reassuring narrative.
This is the 5th largest jump ever in 30-year yields. I got this from, I think it was Gemini AI, because I just put it in Google and then it gave me this little list. So here we have the biggest daily moves in the 30-year Treasury yield, March 19th, 2020 during the lockdowns, October 13th, 2008 during the Great Financial Crisis, March 18th, 2009, right at the end of the stock market collapse, which ended on March 6th. So about 2 weeks later, you had this huge rise in bond yields, June 5th, 2009, and finally July 29th, 2026. And this was a lot lower than those other ones during the financial crisis, but it's still a humongous move in bond yields, especially for the Fed doing nothing. And why is that happening? Well, because the Fed is losing control of consumer prices, and they're supposed to hike when consumer prices start to get out of control, which they are now, but they aren't, which means that they're not going to control inflation, and long-term bond investors are reacting. And that means that eventually, pretty soon, the Fed is going to have to buy those bonds themselves to get those long-term rates down. And that will be the emergency cut to zero. And that will be the end of the dollar shortly after that. So we will get there soon. We're on the way. And these huge moves in bond yields are not normal, and they are signaling something is coming down the pike. But now let's go into the bottoming pattern here.
Bond markets rarely deliver historic moves without forcing policymakers to pay attention. What Rafi Farber is highlighting is that one of the largest daily jumps in 30-year yields belongs in a group previously associated with periods of severe financial stress. Whether or not the same outcome follows, institutional investors appear to be repricing long-term risk faster than official messaging suggests. The divergence deserves far more attention than the latest headlines. Next, Rafi Farber reveals why gold's chart may already be anticipating what bond traders see.
First thing I want to show you is that we are at the end of a humongous triangle.
Can you relax your triangle of sadness?
Not that humongous, kind of like big, I would say. Big is better than humongous. It started here in at the gold top. If you can see, the candle hits here at about 5,600. That is the top in gold from January 29th. And we've been in a very, very tight triangle ever since. We hit here in March, and we hit here in May, and then here in June. And now we are at the apex, where this is the bottom. Goes back to about November of 2025, and now we are skirting along this bottom. And why is this a bottoming pattern and not a continuation of a bear market? Well, let's go into the charts, and you'll see. Oh, I forgot about this slide. By the way, this is the highest 30-year yield since mid-2007. And what happened in mid-2007? Well, that was when stocks, the S&P 500 and the Dow, topped just prior to the great financial crisis of 2008. There was about a year delay. I don't think there's going to be a year delay this time because things are going a lot faster now. But we're there in yields, and we'll see when it starts to infect the credit system. And when it does, and there's a crunch, there's going to be printing, and that will be the end of the dollar as we know it.
Wall Street celebrates rising markets, yet long-term Treasury yields are revisiting levels last seen before the 2008 crisis unfolded. Rafi Farber's argument suggests investors should pay closer attention to tightening financial conditions than comforting economic narratives. Technical patterns alone never guarantee direction, but history shows liquidity stress often appears before the broader economy reacts. Waiting for official confirmation has rarely protected purchasing power. Next, Rafi Farber unravels why gold's consolidation may contradict the prevailing bearish narrative.
And and the start of a new monetary system based on gold and silver. 6 to 8 week bottoming pattern so far. So this is really the reason why I'm pretty sure this is a bottoming pattern. Nothing is 100%, but here's the evidence as I have it laid out. So we have a 6 to 8 week bottoming pattern. It depends how you count it. If you count it from here, this little candle over here where my cursor is, then it's 8 weeks. If you count it from here, it depends on how you want to count it. This is not an exact science, so pick whichever count you want to take. I'm taking 6 here. So we have a 6 week bottoming pattern. These are weekly candles. 1, 2, 3, 4, 5, 6. We don't know where it's going to go yet, but this is a very tight coiling pattern. And where did we see that pattern before? Well, we saw it in the 2015 gold bear market bottom. This is a about 6 week bottoming pattern. You can also call it 8 weeks if you want to count these two. Again, this is not an exact count, but it's either 6 to 8. I'm taking 6 here again because this bottom is slightly lower than over here. And in this box, you have 1, 2, 3, 4, 5, 6. And then we had takeoff in the gold market. So 6 week bottoming patterns. 2015, 2026, but there are a lot more. There was a 9 week bottoming pattern and then 2 6 week bottoming patterns in 2018 and 2019.
Small price ranges often hide the biggest changes in investor psychology before major trends emerge. This is where Rafi Farber's thesis shifts from headlines toward historical chart behavior, comparing today's consolidation with prior gold recoveries. Technical similarities deserve attention, although no pattern guarantees identical outcomes across different economic cycles. Long-term investors benefit more from disciplined observation than emotional reactions to short-term volatility. Next, Rafi Farber reveals why similar formations were surprisingly rare during prolonged bear markets.
You had here 9 weeks. This was one of the longest that we've had in 2018. 1, 2, 3, 4, 5, 6, 7, 8, 9 before we had the next move up in gold. And then again here we had a 6 week coiling pattern. 1, 2, 3, 4, 5, 6 like we have now, and then another move up. And then we had another correction. And then 1, 2, 3, 4, 5, 6 week bottoming pattern again. And how long are these corrections? This one was from mid-February to about mid-May. So February, March, April, May, about 3 months. This was also about 4 months. We've had about 6 months so far in the current correction. In 2022, we had a very similar pattern, a 7 week bottoming pattern over here. Count the candles, 1, 2, 3, 4, 5, 6, 7 before we took off again in the next move up. And how many of these did we have during the 2011 to 2015 bear market? Did we have any of these coiling patterns? Well, there was one, and one only in 4 years. It was this one. In 2012, we had a 1, 2, 3, 4, 5, 6, 7, 8, 9. This was a about 9 or 10 week bottoming pattern, a very, very long one. And it led to a little bit of a rally here, but that rally failed eventually. So what I'm trying to say is that these patterns are very rare during bear markets. It happened once over here, and that was a fake out, but it hadn't happened from then until the final bottom over here in 2015, which
most investors chase rallies, but market bottoms usually form while confidence quietly disappears. Rafi Farber notes repeated 6 to 9 week consolidation patterns have historically appeared near important turning points, more often than during extended declines. That observation doesn't guarantee another advance, yet it challenges assumptions that every pause automatically signals renewed weakness. Investors who study probabilities instead of headlines often recognize opportunities earlier. Next, Rafi Farber exposes why today's macro backdrop could matter even more than the chart itself.
which was the first 6 week bottoming pattern that we counted in those charts from the previous slides. So we have an environment right now where higher interest rates on the long end are the response to the Fed not doing anything, not cutting, not hiking, just doing nothing, and long-term yields head up. So imagine what long-term yields do when they hike, when price inflation gets even more out of control than it already is, because the Strait of Hormuz is still blocked and the world is about to run out of oil. I don't know when that's going to happen, but I don't know how much longer the Strait of Hormuz and the Strait of Bab al-Mandab, or what's it called in the Red Sea? I don't remember. They're also being blocked by the Houthis. Things are getting pretty critical. And when they reach critical and oil spikes, that is going to create another financial crisis. It should be the last one. And these bottoming patterns, these coiling patterns in gold suggest that whatever we have been experiencing for the last 6 months, it's almost over and it will be followed by the next move higher in gold. And this time it could be a doozy.
Watch out for that first step. It's a doozy.
Energy disruptions rarely stay confined to commodity markets because they eventually ripple through inflation, credit, and investor confidence. According to Rafi Farber, rising long-term yields alongside persistent geopolitical risks could amplify pressure across financial markets if supply shocks intensify. The exact outcome remains uncertain, but history shows liquidity conditions can deteriorate faster than public expectations. Wealth preservation often begins before consensus recognizes the risk,